Welcome back to the last and final lesson in the option series. And so today we're going to talk about a few things. We're going to talk about the option chain. Then we're going to kind of connect it into a real world example, which will kind of just be built off the option chain. And then we're going to talk about a bonus topic, which, well, I'll introduce later in the video. Before I say my goodbyes for this series, there might actually be a bonus lesson that'll be posted. I gotta see, there's a few things I still wanted to talk about in the options, so we'll see if I make a bonus video. But for now, this is the last video you should watch to actually understand options and get into the market. Let's get started. So this slide is about getting hands-on with the option chain. So it's like a real-world tool you use every time you place a trade. So right here is an option chain. It's a theoretical I made. This is not really what it looks like. They usually sometimes have less information, sometimes have more information. It depends. This one's just here because it'll be built off an example. But yeah. So on most platforms, calls are listed on the left and puts are listed on the right, as we can see here. The center column shows the strike price, which each row is a strike. At the top, you'll see a drop down to select the expiration date, like September, let's say 2025. This one doesn't have it because this is not a real option chain. And you choose an expiration and the chain loads all the strike prices available for that date. So that's kind of how an option chain works. There are some key data columns, and we're going to walk through them. So the first one is the bid and the ask. Okay. The bid is what buyers are offering, and ask is what sellers want. It's pretty self-explanatory. The difference between them is the spread. I've mentioned the word spread a lot. That is the spread. It's the difference between the bid and the ask. And so the tighter the spread, meaning the closer the bid and the ask are, it means there's more liquidity. The option is more liquid, which is good because the more liquidity means better fills. It means it's easier for your order to go through because there's what you're willing to bid and the ask is very close, right? There's someone that's willing to take that price, so it's easy. On the other hand, obviously wide spreads, it means the option is illiquid and it's rarely traded and it's hard for an order to go through if you were to place one. Then you have something called the last price. Do I have it here? I don't think I do. But basically the last price is the most recent trade on that contract. No, it's not always relevant. It could be stale. And use bid ask for real-time pricing, not last traded. So it's better to look at the bid ask. Don't really look at the last price. Then you have the volumes. Right here we have a call volume and a put volume. The volume is quite important. It tells you how many contracts traded today. The higher the volume, the higher activity, easier to get filled, right? So if you have a very tight spread and you have a high volume, it means your order will go through really, really easily. On the other hand, obviously a low volume, well, you might have trouble getting in or out because there's not that many trades being placed. Another very key important term is called open interest, which will be OI. It is a total number of outstanding contracts. A high open interest, it means contract is popular and well traded. A low open interest, I'm just saying OI. A low OI, it means less interest, harder to exit. Obviously, we have the very important implied volatility. We've talked about this already, but I'm going to mention it again. Very, very important. It tells you market's expectation of future movement. A higher implied volatility, higher IV, it means there's a higher option price, but it also means more risk is priced in. And you already know that implied volatility crush can hit right after earnings, right? And right here we also have delta. We've talked about this as well. It's the most used Greek. We call it the Greek because delta comes after Greek, so we just say the most used Greek. It measures how much the option price will change if the stock moves to $1. It also represents the probability of expiring ITM. ITM, if you don't remember, it's in the money. It's kind of like a rough estimate. And let's say a delta of 0.3 means that options price will move 30 cents for every $1 move in the stock. And there's a 30% chance it expires in the money. That's kind of how what's it called? Delta works. So let's kind of build on this like an example. Let's say Apple is trading at $190. You're looking at the 195 call, which is right here. 195 call expiring in 30 days. The bid ask right here is 125 and 1.3, which means there's a very tight spread and it's liquid. Now we're going to look at the volume. The volume is 4,500. It means it's very, very active today. Open interest, we're going to look right here. The open interest is 18,000. That's how many contracts are open. If we look at the implied volatility of 27%, this means there's a moderate volatility, and a delta of 0.32 means there's bullish, but it's not too aggressive. And so what you know is that this is a very popular liquid option with manageable risk and a decent chance of expiring in the money, which is pretty good. And so what you're looking for, and when you're analyzing the chain, you always ask, is there a tight spread? Is there enough volume and open interest to get in and out easily? Is implied volatility reasonable, or are premiums overpriced? Does the delta match your directional thesis? And so this is like a real world research, and it separates option traders from gamblers. Looking at the option chain is very, very important. Let's walk through a real trade using the same sample we just talked about in Apple option chains we just reviewed. Let's say Apple is trading at 190, right? And you're bullish in the short term, but not overly aggressive. So you expect like a moderate move higher in the next 30 days. So the strategy is you buy the 195 call, which expires next month. So, well, actually, let's look at the data first. Your strike price is 195. Your call bid ask is 125, 1.3. Your volume is this. This is the same thing from the last. I just moved it over into so you could just see just those points. So your entry price, you enter with the limit order at $1.30, which is the ask price. Your max loss is $130, right? Because when you're buying an option, you're buying it at 100 contracts, right? And so if the ask is 130, multiply that by 100 because you're buying 100 contracts. 100 shares. 1.3 premium for each times 100, $130. Your max loss is going to be $130. So you cannot lose more than $100. Your max gain, on the other hand, well, obviously it's unlimited because we're betting that the stock will go up and we'll make money from that. So technically, so the reason it's called unlimited is because a stock can go up to the roof. Like it keep going. Obviously it won't. There's always like a point it will stop. But in theory, the stock could keep going and fly to the moon. And the break even, well, our break even point will be $195 strike plus $1.30 per premium. So our break even point is 196.3. So this means you need Apple to rise above 196.3 at expiration to profit. Anything below that is a partial or full loss. Well, why this trade? Well, delta of 0.32 means there's a 32% chance this expires in the money. You're not deep in the money, so the premium is quite cheap. Also, volume and open interest are strong. This means great liquidity. And your implied volatility is stable at 27%, which means there's no major earnings, events expected, or anything like that that will kind of set off the stock. And so this is like a classic setup for someone with a modest bullish thesis who wants to define risk and leverage upside. However, what if the trade moves? Well, if Apple moves to 193, the options might rise to $2. If Apple hits 197, you're at break even and profit begins. So technically, you're a little past. You're kind of in the profits. You're basically in the profits. Like you are in the profits, but it's just not much. And if Apple falls or stays flat, your option decays, especially in the final 2 weeks. There are some key risks, though, you got to remember. Obviously, remember we talked about this a couple times. Theta, which is time decay, it works against you daily. As closer to your expiration, the value decreases. If the move comes late, even if Apple reaches 195 in the expiration, you might still lose due to time and decay. And this kind of highlights why it's not just the direction that matters, but timing and volatility too. So you got to kind of have those key risks in your head to always remember. So managing the position. Once you've placed the trade, in our case, buying Apple at $195 call for $1.30, the work isn't over. Now comes trade management, which is just as important as placing that trade, which often kind of separates consistent traders from hopeful guessers. To be a good trader, you should also be able to manage your position. First things first, order execution. Always use a limit order, never market order. And this is to avoid getting filled at inflated prices. You enter this trade at 130 and you're watching the position closely. You want to use a limit order. Second is price and time sensitivity. Options don't just move with stock price, they also change with time and volatility. For instance, if Apple jumps to 194 very quickly, the option might jump from 130 to 210. That's a 60% return. But if the same move happens 3 weeks later, your option might only be worth 150, but time decay has eroded its value. Another thing you gotta is managing risk. You should always have a profit target and a stop loss in mind. For example, if your profit target is like sell the option if it hits $2, two or more, or stop loss exit if the value drops to 70 cents. Why? Well, because once your thesis breaks or the trade loses steam, it's better to lock in profit or cut losses systematically. You could lose money. Or, I'll give you a scenario. Would you rather lose a little bit of money or take the risk and lose a lot more or maybe still make money? Personally, I'd rather take a little loss, and knowing that I could have lost even more, it kind of just makes me more comfortable, and I'd rather just take that very little loss than hopefully gamble for a bigger loss or a win. Another thing you gotta remember is early exit compared to holding. You don't need to hold until expiration. If the trade moves in your favor and the option value spikes early, just take the profits. Holding longer often increases risk, especially as data accelerates closer to expiration. You should also use alerts. You should watch earnings, news, and react proactively, not emotionally. Another thing is adjustment in rolls. If Apple is moving your way but slowly, you could roll the call out to a later expiration to buy more time, or roll it closer to the money to lock in some gains and stay in the trade. This introduces more complex management, but it becomes very, very essential as you grow. So kind of like a final tip, track your Greeks as the trade matures. Delta will rise if Apple goes up, so your trade becomes more sensitive. Theta will increase as time passes, so premium erodes faster. And implied volatility rising or falling can inflate or crush your option value even if the price doesn't change. Now in the final slide, the next slide, we'll introduce one of the most advanced but most powerful ideas in options, which is called synthetic positions. And so this is how you can create a long or short stock exposure using options only. So imagine being able to replicate the exact risk reward of owning a stock without actually buying it, or shorting a stock without borrowing shares. That's exactly what synthetic positions lets you do. For instance, let's say we're going to talk about first a synthetic long. Also, synthetic long stock, also called a synthetic long. And this kind of mimics buying 100 shares of stocks. To build one, first you got to buy a call, you got to sell a put. And with both obviously with the same strike and same expiration. So in our previous example, let's say Apple's trading at 190, you buy the 190 call and you sell the 190 put. Now you have a synthetic long exposure. So if Apple rise, the call gained value. If Apple falls, the short put creates a loss. Just like if you own shares. And your profit loss graph is identical to owning the stock. And then there's also synthetic short, which is the same thing, but it's the opposite. It's to bet against the stock using options only. What you do, you buy a put and you sell a call. Again, same strike and expiration. This gives you synthetic short exposure. Your profit and loss mirrors shorting the stock, but you never borrow shares and you can control risk more preciously. Now the real question is, well, why do we use synthetic position? Well, first things first, it's very capital efficient. You don't tie up cash buying 100 shares. Instead, you use margin and collect premiums from the put, which offset the call cost. Another one is flexibility. You can exit either legs separately and adjust the trade if your thesis changes. Another one is option only accounts. In some accounts like IRAs or small margin accounts, synthetic positions let you trade directionally without needing to buy or short the stock. There are obviously risks in consideration. You're still taking on directional risk. If the stock moves in the wrong way, you lose. Also, short puts and calls come with assignment risk, which means you could be forced to buy or deliver shares. Another one is margin is required. This isn't for cash accounts. So kind of the final thoughts. Synthetic positions are kind of like the gateway to advanced trading strategies. They also help you understand how every option contract is connected and how the pricing of calls, puts, and stocks all tie into put-call parity, which is a deep concept for another time. This kind of strategy, pros and hedge funds use every day, and now you know how it works too. I hope this video helps you. I'll actually just tell you right now, there will be a bonus section, so there will be more videos after this. I don't know how many, but I'm going to create a bonus section where we kind of talk more in depth and like more advanced concepts like this one about options. Hope you guys enjoy this video, and I'll see you not that soon, but hopefully soon. Thank you.